Picture a product so potent that it earns money without creating any physical good. A product so intangible that most people don't even notice they're purchasing it every day of their lives. That product is debt. And rather than being a harmless financial tool, debt has been intentionally shaped into the most lucrative product humanity has ever known. It has financed wars, brought down empires, bound entire nations, and quietly siphoned wealth from everyday people. Yet if you ask most individuals where debt originated, who built it, or why it sits at the center of our financial system, they wouldn't have an answer. The history of debt isn't merely an economic tale. It's the story of money and power intertwined. At its core, debt is a promise. You take something now and commit to repaying it later. But hidden within that promise lies the true engine of financial control: interest. Charging interest turns the future into profit. For thousands of years, societies wrestle with this idea. In ancient Mesopotamia, debts were recorded on clay tablets, yet rulers also periodically erased them through debt jubilees, knowing that when too many people became trapped by obligations, the entire system would break down. In the Hebrew Bible, debts are ordered to be forgiven every 50 years. The logic was straightforward: debt was dangerous. Left unchecked, it could enslave whole populations. But as history moved forward, elites learned not how to eliminate debt, but how to weaponize it. In medieval Europe, the Catholic Church formally banned usury, the practice of charging excessive interest. Still, merchants and bankers found ways around the ban. They masked loans as trade agreements or engineered complex credit arrangements that looked like anything but lending. By the time of the Renaissance, influential banking dynasties, such as the Medici of Florence, had built vast empires not through territory or military force, but through lending. They funded kings, popes, and merchants, and in exchange gained not just financial returns but immense political influence. Debt was no longer merely a financial tool. It had become a source of power. The most significant shift occurred in the 17th century with the emergence of government debt. During its struggle for independence from Spain, the Dutch Republic raised funds by issuing bonds to its own population. Citizens could purchase state debt, earn interest on it, and trade those bonds as assets. This changed warfare forever. Military campaigns were no longer constrained by the gold or silver held in a monarch's vaults. They could be sustained by selling future obligations. The Dutch refined this system, and England soon followed their example. With the founding of the Bank of England in 1694, national debt was institutionalized on a permanent basis. Rather than borrowing from private individuals, the state now borrowed through a central bank, which issued paper money backed by government loans. For the first time, states no longer took on debt only during moments of crisis. They survived on it, continuously renewing their obligations. The financiers who administered this system became essential to royal power. Debt had evolved from a series of private agreements into the very backbone of government authority. The returns were immense. Lending to states was considered the safest investment available, since governments could always levy taxes to repay those who funded them. Conflicts that once would have ruined monarchs financially could now be sustained without limit. Those wars, in turn, fueled imperial expansion, unlocked new markets, and generated even more demand for borrowing. It became a self-reinforcing cycle. The more countries fought, the more they borrowed. The more they borrowed, the wealthier their lenders grew. By the 18th and 19th centuries, the bond markets of London, Paris, and Amsterdam had become the central pulse of the global financial system. Armies advanced, ships crossed the seas, and colonies were taken, all financed with borrowed money. But this wasn't only a story about states. As industrial capitalism expanded, everyday people were pulled into the same cycle. Railways, factories, and major infrastructure were built on credit, funded through bonds and bank loans. Workers earned wages from companies sustained by debt and then borrowed themselves to purchase homes, tools, and eventually consumer goods. Debt spread into every layer of economic life. By the 20th century, it was no longer just an instrument used by governments or industrial elites. It had become a routine product sold to the public. Mortgages, auto loans, credit cards, student loans. The entire framework of modern life was designed to make borrowing the default condition of existence. And this is where its hidden brilliance, or its concealed cruelty, reveals itself. Debt doesn't produce profit, just once. Every interest payment shifts wealth from borrower to lender, from the many to the few, over and over again, month after month, year after year. Unlike a one-time purchase, debt is structured to endure, binding people into payment cycles that rarely fully end. A home financed with a 30-year mortgage often ends up costing 2 or even 3 times its original price. A credit card balance carried from month to month can grow faster than the borrower's capacity to repay it. What starts as a simple agreement slowly turns into a snare. In this sense, debt is more than a financial contract. It is the most effective business model ever created. It needs no factories, no stockpiles, no physical inputs. It extracts value from time itself. And those who grasped this earliest, the traders of Amsterdam, the bankers of London, the financiers of Wall Street, went on to design the foundations of the modern financial system. This system doesn't merely oversee debt. It produces it, multiplies it, and relies on its constant expansion to function. By the mid-20th century, borrowing had ceased to be an emergency measure and instead became the bloodstream of the global financial order. The Bretton Woods Agreements of 1944, often praised as the foundation of modern international cooperation, formalized this condition. Institutions like the International Monetary Fund and the World Bank were created to provide loans to countries facing crisis or pursuing development. Yet beneath the elevated language lay a straightforward principle: debt as a form of control. Nations were allowed to borrow, but only under conditions set by their lenders. The IMF, largely shaped by the United States and European powers, began tying loans to structural adjustment requirements. Entire economies were instructed on what to cut, what to sell off, and how to reorganize public finances. Debt was no longer just lucrative. It became a political tool. Countries that accumulated too much found their independence weakened, with key decisions made not in their own capitals, but in places like Washington or Basel. The official narrative spoke of stability and growth. The lived reality was dependence. At the same time, a quieter shift was unfolding in everyday life. In the decades following World War II, banks learned how to market debt not only to states and corporations, but directly to families. The home mortgage emerged as the centerpiece of middle-class ambition. Home ownership, once limited to the privileged few, suddenly became attainable for millions, but only by committing to decades of repayments. Auto loans, installment plans for furniture, and eventually credit cards turned borrowing into a consumer commodity, marketed like any other product. The psychological transformation was profound. Debt was no longer viewed as a stigma or an exception. It became the standard path to sharing in prosperity. Buy now, pay later. Enjoy the present and let tomorrow absorb the cost. For banks, this shift was extraordinarily lucrative. Interest collected from millions of households generated reliable, compounding returns. For governments, easy credit created the appearance of continuous growth, allowing consumption to rise even as wages stalled. For corporations, it ensured a constant flow of customers encouraged to spend money they had not yet earned. Borrowing became the unseen engine driving modern capitalism. And unlike physical goods, credit could be expanded without limit. There was no need to mine resources or construct factories, only contract, signatures, and the authority to create money from future promises. The danger, of course, was dependence. The entire system grew reliant on constant expansion. Banks had little incentive for debts to be paid off quickly. They preferred loans to be renewed, refinanced, and prolonged. The longer people remained in debt, the more profitable they were. Governments also discovered that borrowing was politically easier than taxation, allowing leaders to offer benefits now while shifting the burden to future generations. Central banks, with their ability to create money, underpinned the process by providing endless liquidity to keep the system moving. Debt was no longer a temporary bridge. It had become the permanent framework of the financial order. By the 1970s and 1980s, the costs of this dependence were impossible to overlook. Many developing nations in Latin America, Africa, and Asia had taken on massive debts during years of easy money. Western banks, flush with recycled petrodollars after the oil shocks, encouraged this borrowing. When interest rates were later driven sharply higher under Federal Reserve Chairman Paul Volcker, these countries suddenly found themselves unable to meet their obligations. The crisis erupted in 1982 when Mexico declared it could no longer service its debt. The proposed remedy was more borrowing, imposed under even stricter conditions by the IMF and the World Bank. Debt turned into a snare, Countries borrowed to stay afloat, then borrowed again just to repay earlier loans. With each round, they surrendered greater control over their economies. Ordinary people endured austerity, rising prices, and job losses, while creditors and elites continued to collect interest. At the same time, in wealthier economies, the financial sector invented new ways to repackage and trade debt itself. Mortgages, auto loans, and corporate bonds were bundled into securities and sold across global markets. Borrowing was no longer simply an agreement between a lender and a borrower. It became a tradable asset, broken apart and distributed worldwide. Wall Street shifted away from producing tangible goods and toward designing increasingly complex debt products. This transformation, known as financialization, made credit the central raw material of the modern era. The profits were enormous. Banks could issue a loan, sell it on, and immediately move to the next one, earning fees at every stage. Risk was claimed to be dispersed, but in reality it was merely concealed, waiting for the next shock to expose it. The financial crisis of 2008 was the inevitable result. Trillions of dollars in mortgage-backed securities, built on the assumption that American homeowners would never default in large numbers, collapsed almost overnight. Debt had been pushed far beyond what reality could sustain. When it finally broke, the shockwaves rippled through the entire global financial system. Governments intervened, not to hold the creators of toxic debt accountable, but to save them, once again revealing who the system truly protects. Ordinary families lost their homes, their jobs, and their savings. Banks were rescued, and when the crisis passed, borrowing didn't retreat. It expanded. The disaster caused by excessive debt was used to justify even more of it, through central bank bailouts, emergency programs, and ultra-low interest rates. By this point, debt was no longer just lucrative. It was essential. Every corner of the global economy relied on it. Governments financing deficits, corporations funding stock buybacks, households maintaining their standard of living. Without continuous borrowing, the system would seize up. Debt had become the foundational product that kept everything else running endlessly issued, renewed, and inflated. It was the ideal business model. It demanded no innovation, no physical production, only the faith of borrowers and the backing of the state. After 2008, central banks drove interest rates to near zero and poured liquidity into markets, promising this extraordinary remedy would restore balance. In reality, it deepened the dependence. Cheap money pushed governments, companies, and families to take on even more debt. The scale is astonishing. Global debt now surpasses $300 trillion, more than 3 times the world's yearly economic output. Never before has humanity owed so much to so few. And the paradox is that this towering burden is celebrated as progress. Leaders point to rising GDP while quietly recognizing that much of it is simply pulled forward from the future. Debt has become so normalized that it barely raises questions anymore. A 20-year-old is encouraged to accept tens of thousands in student loans, sold as an investment in tomorrow. A couple signs a 30-year mortgage, marketed not as a liability, but as the fulfillment of a dream. States operate with deficits year after year, and most voters scarcely react because the costs remain hidden in the short run. Inflation acts as a silent levy, making those deficits manageable by steadily eroding the purchasing power of money in people's hands while leaving the nominal structure of debt intact. What appears to be economic health is often nothing more than layers of leverage piled on top of one another. Yet the profitability of borrowing has never been greater. Banks collect interest on every loan, but they also build entire sectors around managing debt, refinancing, collections, and restructurings. Investors generate enormous returns trading government bonds, wagering on the financial reliability of whole countries. Hedge funds target distressed debt, extracting profits from the collapse of nations or the struggles of failing companies. Credit rating agencies, presented as impartial arbiters, function as gatekeepers that determine who can borrow cheaply and who must pay a higher price. Debt has become more than a financial instrument. It is an entire marketplace where promises are valued, exchanged, and exploited. One of the system's most defining traits is its ability to concentrate wealth. Each interest payment moves money from borrower to lender. Over time, this channels resources upward, from millions of households paying mortgages and credit card bills to the ledgers of major banks and investment funds. Debt doesn't merely produce profit. It restructures society by hardwiring inequality into the system. Those who already own assets can borrow at low cost to acquire even more, turning existing wealth into ever greater wealth. Those without assets must borrow at high rates, often becoming stuck in endless repayment loops. In this way, debt reflects class divisions, refined, justified, and reinforced by modern finance. Now, as central banks move toward digital currencies, a new stage of debt is approaching. Picture money that is programmable, fully traceable, and controllable at the level of code. Loans approved or rejected automatically by algorithms. Interest rates adjusted instantly. Penalties applied without delay. To some, this sounds like progress and efficiency. But history shows that efficiency for lenders almost always translates into reduced freedom for borrowers. The most lucrative product ever invented is simply being upgraded for the digital era, once again designed behind closed doors, far from public scrutiny. So what is the takeaway? Debt is not neutral. It is not merely a helpful tool or a natural feature of modern economies. It has been intentionally developed into the most profitable product humanity has ever known, one that converts time into money and turns individual aspirations and national struggles into steady streams of interest flowing upward. To truly understand debt is to recognize that financial independence will never be granted by a system that depends on keeping people indebted. Real wealth lies in reducing reliance on borrowing, questioning the allure of easy credit, and seeing every loan offer for what it is, part of a machine built to extract value from your future. History may not repeat itself exactly, but the pattern never disappears. From Mesopotamian clay tablets to suburban mortgages, from Dutch bond markets to Wall Street derivatives, the narrative is consistent. Debt rewards the creditor, weighs down the debtor, and reshapes the world to favor those who control the movement of money. And perhaps the cruelest illusion of all is that we are taught to applaud it, to label it progress and confuse borrowing with prosperity. If this shifted your perspective, hit subscribe. History holds the answers, and I'll show you where to find them.